Hi, good week to all. This is Kelvin here again. Welcome to this week's latest edition of our weekly technical outlook on the major stock indices, the SPX 500, the Nasdaq 100, the Hong Kong 50, the Japan 225, and the German 40 for the week of 30th of May to 3rd of June 2022. As usual, I'll be covering the latest key levels and trend bias for this coming week. So, before we start, let's take a look at the disclaimer slides first. All right. So now let's take a look at the momentum analysis across the globe from US, Asia, and Europe for last week and take into comparison of its prior week. So what we could see over here is a very strong outperformance of the US benchmark stock indices, all the way from the SPX 500, the Nasdaq 100, which is growth centric, the Dow Jones Industrial Average, and the Russell 2000, which represents the small cap stocks. So all in all, we'll start to see a very strong, stellar performance on the US stock indices, especially on the worst hit stock indices that was actually being inflicted with kind of pain in the last 3 to 4 weeks. As you all know that in the last 7 weeks, it actually traded downwards, that means shaping lower lows. And it's only last week it started to shape a weekly performance that is the best weekly gain that is seen close to 2 years. So strong outperformance in the growth centric, which is the tech heavy Nasdaq 100, as well as the small cap Russell 2000, 7.2% and 6.5%. As you all could see that it clearly surpassed its prior week performance and as well as its prior 4 week average, giving a kind of a momentum, incremental in momentum, upside momentum, as depicted by the difference between last week performance and its prior 4 week average. All in all, close to an average of 8 to 9%. It's seen in the benchmark US stock indices. So last week was pretty muted on the Asia-centric benchmark, like the Hang Seng Index, the Hang Seng Tech Index, which is comprised of the China big tech stocks, and the Japan Nikkei 225, all closing in the red, almost unchanged, I would say, for the Hang Seng Index, especially the Nikkei 225, which is 0.2%, and the underperformer was the China big tech stock, which is at negative 2.3%. And also, on lastly, the European indices, as represented by the German DAX, pretty healthy at 3.44% versus last week performance, which was almost unchanged at negative 3%, and give us upside momentum of 3.7% if we take into account of the difference between last week performance and its prior 4 week average. So all in all, what we could see over here is that the indices right now is actually shaping this potential 1 to 3 weeks of corrective rally in play within this major downtrend that is still in place since the start of this year. So before we jump into the technical chart of the various benchmark indices that I usually share, let's take a quick look at the 11 sectors, which is the 11 S&P sectors that made up of the SPX 500 index for the last week performance. So overall, 11 of them are close in the green, and without much surprises, the top uh, performing sectors are actually the one that was badly hit in the last 3 to 4 weeks, which is the consumer discretionary, up 9% last week, and the energy, which is close to about 2 or 3 weeks in a row already, is still featured as the top three outperformer from a weekly basis. Last week up 8.1%, followed by the technology, which is also similar gains at 8.1% as well. So all in all, right, what we could see right now is we start to see what I call a healthy distribution across this sector from a weekly performance basis. But however, I'd like to share with you all from a technical perspective over here is that we are still not out in the woods yet for this major downtrend to say that it has been invalidated from the start of this year. So to actually explain much in further, I got to share with you the technical analysis chart. Okay, so let's quickly go to the technical chart. Okay, so this is our CMC Next platform. Let's start with the SPX 500 first. So for those who actually followed my video, I will always start with the higher time frame chart before going down to the strategy chart, which is the 4 hour chart. All right. So what we could see over here is that since the start of the year, which is 4th of Jan, that's the all-time high, it's been trading in a major downtrend, very clearly depicted by the price action still below the 50-day moving average and the 200-day moving average. as depicted by the blue line, which is the 50-day moving average, and the orange line over here is the 200-day moving average. And also, if you look at the elliott wave perspective, over here is that right now we could be retracing this wave 3 down move, which is the start of 30th of March high, all the way down to 19th of May low. And this is the potential way forward. And if you could still recall in our last week video, we did highlight the risk of this impending corrective rally, one to trade rally that is likely to take shape very soon, which is indeed it actually happened in the last two trading days of last week, Thursday and Friday. You could see over here. And what's interesting over here is the RSI still remains kept by this descending trendline resistance at 60% level. So all in all, what we could see over here is that potential bracket wave for corrective rally, the resistance level to watch or the end level where it could actually travel to on the upside will be 4217, 4310 level. So what is 4217? So 4217, if I were to take a look at it, it will be corresponding to this former swing low area of 23rd of February 2022. And if I could draw the Fibo retracement taking from the start of the wave 2 to the end of the bearish wave 3 is at 50%, and 4310 is at 61.8%, which is the former swing high, former high swing, okay, the swing high area of 25th of April to 5th of May, where price action got rejected before shipping this last prior steep move down that was seen in the 3 to 4 weeks ago. All right, so this is a bunch of critical resistance level where potentially we may expect this corrective rally that is in place since last Thursday to actually stall and reverse to the downside. So this is what we have our strategy for this week. So to play that move, this potential corrective rally that is in place since last Thursday, we will have a key medium-term pivotal support that I have for this week, which is at 39.7, 39.7, 39.67 level, pardon me, 39.67 level. So it's actually the former swing high area of 23rd of May now turns into a pullback support level. So looking for a pullback. Okay, so why there's a potential pullback? If you look at the 4-hour RSI is coming very close to an extreme overbought level at 77%. So usually once it hit this extreme overbought level at 77%, in the past it would tend to see a what you call it a negative price reaction on the index itself. All right. So now coming very close to this level again. So we are expecting at least a pullback. 40.46 maximum 39.67, which is our medium-term pivotal support level that we have for this week to maintain this potential corrective rally towards 4217 maximum 4310, which we depicted earlier on, and also this descending channel resistance that is being drawn from the high of 30th of March. So all in all, right, we're still looking to play this potential corrective rally before hitting a inflection level, which is 4217 slash 4310 on the SPX. Then thereafter, we could start to see the risk of another down leg could take us much lower towards 3840 slash 10, which is the swing low area of 20th of May, and a break below it should take us much lower towards 3760 slash 3720 again to to actually complete this move of a bearish wave 5 of a major downtrend A. Okay, now moving on to the Nasdaq 100. So the Nasdaq 100 over here on the, let's go to the daily chart first. So as you can see on the daily chart, right, we are still evolving in a major downtrend since its all-time high of November 2021. So all in all, right, it's still trading below the 50-day moving average depicted by this blue line, and the 200-day moving average depicted by this orange line. And also the daily RSI still remains kept by this key descending resistance level correspondingly at the 57%. And also based on the elliott wave perspective, we are now shipping that corrective wave 4 to actually retrace this wave 3 down move that has been that took place since the high of 29th of March all the way down to the low of 20th of May. And if you were to look at the resistance level where that potential corrective waveform may store, will be at 12,960, followed by 13,495, which is this very clearly this congestion, former congestion zone over here, the former swing high area of 24th of March, and as well as the swing high area of 26th of April and 4th of May before this last 3 to 4 weeks of steep decline took place. And if you do the Fibo retracement from the start of wave 3 to the end of that wave bracket, wave 3 is at 38.2% and 50%. So for the strategy for this week, what we have is that we will actually have a key medium-term pivotal support at 12,030. So based on the current price action right now, if you look at the 4-hour RSI, it already reached a key, we call it extreme overbought level at the 74% that is in place since 2nd of February this year, where the 4 RSI hit this extreme overbought level at 74%. Thereafter, the price action actually shaped a decline as well. All right. So if we are now back at this level again, where the price action after last 2 days of steep up move since Thursday, we may start to see a pullback towards 12,340 maximum, the key medium term pivotal support at 12,030. So as long as 12,030 holds, we are still expecting another leg of corrective rally towards 12,960 maximum 12,495 as depicted on the daily chart. Then thereafter, we may start to see the start of another potential down leg. So this is a key inflection zone where the bearish pressure may reinsert itself to shape this bearish impulsive wave 5 to actually complete that that major downtrend move of wave A for the Nasdaq 100. Okay, now moving on will be the Hong Kong 50 or the Seng Index. So if you look at the Seng Index over here, last week, it actually surpassed this minor descending trend line, former descending trend line that is in place since 10th of February 2022 high. All right, so now turns pullback support at 20,294. So what we do is that we are still we be looking for this extension of this corrective rally to actually potentially hit 21,900 key inflection level before a key inflection resistance. Why? Because if you look at it over here is this congestion zone, resistance zone, the swing high area of 8th of April, and as well as we draw the Fibo retracement taking from the high of 4th of April all the way down to the recent low where this corrective rally started, will be at the 10 of May low is 76.4%. So we will say that it could be a potential triangle consolidation based on the Fibo retracement, 76.4% on the upside. That if you look at the recent retracement on the downside where it stopped and shaped this ongoing corrective rebound, is if you taken from the low of 15th of March all the way of 4th of April, is also stopped at 76.4%. So 76.4% support, 76.4% resistance, a typical kind of a triangle. We call it range configuration that could be in play based on the Elliott wave perspective. So as long as 19,900 holds, we are expecting a push up, potential push up to 21,900. But however, if we have a 4-hour close between 9,000, 4-hour close below 9,900, then we will start to see another leg of bearish move to actually retest 19,200 slash 18,990 before the swing low area of 15th of March this year at 18,400 slash 18,136 level. Now, the next major Asia indices that I would like to share will be the Nikkei 225 or the Japan 225 that we call in our platform. So let it load for a while. So yeah, here we go. So the Japan 225, all in all, right, if you look at it, it's still stuck within this range configuration between 25,700, which was 12th of May swing low area. And also, if we take into account of the Fibo retracement from 8th of March low all the way up to the high of 29th of March is at around 76.4% retracement as well. So it could be then what we could see over here is that previously all the rally from 12th of November, 6th, 5th of January this year, and as well of 29th of March this year, it has been kind of kept by this descending trendline resistance since this 14th of September 2021 swing high area, which is at 30,716 level. So still pretty stuck in a range configuration for the Nikkei 225. So if I were to look at this week's strategy, is we prefer to have a neutrality stance at 27,760, followed by 26,500, which is the swing low area of 24th of May. And if you could look at the current price action movement over here since the low of 19th of May, it could be shaping this kind of bearish ascending wedge configuration over here that is coming very close to this major descending resistance that is in place since September 2021 high. So given mixed element, we would like to have a neutrality stance between 27,760 and 26,500. So if we have a 4-hour close above 27,760, then we shall start to see a potential kind of a bullish breakout from this descending trendline resistance to retest this swing high area of 29th of March and as well as 13th of Jan, which is at resistance at 28,680. But however, if we have a 4-hour close below 26,500, then we could start to see a drop back towards the range support level at 25,700 slash 25,410. Now, moving on next with the German 40 index. So on the German 40 index, last week it broke above our medium-term pivotal resistance level, which is this descending trend line resistance that is drawn from the high of 5th of Jan this year. Now turns to pullback support at around 13,810 level. All right, 13,800 level. So all in all, right now we could see a further extension of this rally. So it's very similar to the US indices in the last 2 days of last week, Thursday and Friday. It actually shaped this pretty much a significant up move that actually broke above this descending trendline resistance. So taking into account extension of this corrective rally that is in place since 10th of May low, and also depicted by the daily RSI, which has broken above the former resistance level at 56% and still has room to move up before hitting the overbought region and as well as the extreme overbought level at 76% level. So all in all, right, the next key resistance level to watch will be 15,030, which is this former range support that was in place since 6 October all the way to 25th of January this year before this steep decline took shape, now acting as a pullback resistance at 15,030 and as well as the 200-day moving average confluencing closely as well as depicted by this orange line. All right. So all in all, right, for this week's strategy is that we're looking to play this corrective rally as long as 13,800 key medium-term pivotal support holds. Now, do expect a bit of pullback first towards 14,320 as the 4-hour RSI is coming very close to the extreme overbought level at 78%. So looking for a push up towards 14,800 followed by 15,030 key inflection resistance level as depicted on the daily chart. Then thereafter, we may start to see the risk of another impulsive down moves to take us much lower to retest 13,800 and even 13,600 slash 13,340. But however, if you have a 4-hour close immediately this week, a 4-hour close, instead of a bounce, price action come down and have a 4-hour close below 13,800, then all bets of that corrective rally are off. Then which could imply that we are actually saying that this is a what you call it a fake breakout from this descending trendline resistance, and the bearish forces will reinsert itself to actually shape a further push down in first step towards 13,600, 300, then thereafter followed by 13,200. So all in all, right, what we could see over here is a further up move for the major stock indices, except for the Nikkei 225 or the Japan 225, which is kind of a mixed element trading within that range. But however, this rally is more corrective in nature. That means we do not see this rally forming part of a major bottoming formation where it could actually take the index to actually retest the current high that was being made at the start of this year. So more of a corrective rally before the impulsive down move reasserts itself again on the major stock indices. So that's all I have for this week. So have a great trading week ahead. And do remind that today the US market is closed for the Memorial Day holiday. Thank you. And I'll see you again in my next video.